Hello all, and welcome to today's webinar. My name's James Gerrish. I'm going to be your host today, so thanks very much for joining us. Today's webinar is going to be titled 5 Growth Stocks That Won't Die Wondering. So we're going to, last week we looked at resource companies with Peter O'Connor. Thought it was a great overview of the resource sector, and we gave you plenty of ideas to take away and do a bit more research on. Today we're going to focus at the edgier end of the growth spectrum. So today I'm joined by senior analysts John O'Higgins as well as James Bissonella. The guys are coming out of our Melbourne office, so bear with us while we get connected, etc. Well, I'll run you through just a quick overview of the MM investment team and what we're going to cover today. So we've got a focus today on payments. Obviously, been a lot of carnage in the payment space over the last little while. So whether or not there's anything interesting that the guys are seeing there, Aussie Broadband. This is a stock that we own in our emerging companies portfolio. We've got a large position in it. It hasn't done that well for us. So whether or not the thesis still stacks up there. Platforms. So platform business is all about scale and operational leverage. What we're seeing there. Regal Partners, this is a new one for MM. We've actually recently added it to our portfolio, our emerging companies portfolio. So what we're seeing in regards to that company, and then cyber threats. I'm actually going to focus more on the cyber security side there, and the guys have got a couple of interesting picks relating to that. So in terms of the disclaimer, this is general advice only, so you should consult a financial professional before taking any information on board. So just a reminder that it is general information only, and you should consult a financial professional before acting on it. Just in terms of market matters, for those that don't know, we're an investment newsletter. We're a digital advice business. We've got a well-experienced investment team that I lead. Peter White, Peter Winty, Harrison Watt, and then Sean Hickman on the research side, who's our research lead. But without further ado, I'm going to crack on to looking at some of the stocks that we're going to cover today. Jono, James, just checking you're online there. Welcome.
Yeah, g'day. Can you hear us, James? You've got John O'Higgins and James Bissonella.
Can hear you guys. I can't see you. You can turn on your video if you're not shy or not.
Yeah, I think we're just looking at it now. It looks like you're going to have to enable us to push the video on, James.
There we go.
There you go. You should be able to see us.
There you go. There you go. G'day, guys. Welcome to today's webinar. We've got Jono on the screen on the left there, James on the right. We're going to crack on and look at some key stock picks at this point in time. Market Matters subscribers would know both of these guys. We've had the guys on the webinar before, so thank you for that. I'm just going to try and share my screen again, guys. You've taken over. Just one sec, guys. All right. You think by the time there's a pandemic, and how long are we in, guys? That Zoom would have been well and truly worked out by then. So here we go. So you should be seeing my screen there. And one of the first stocks we're going to talk about, guys, is Aussie Broadband. So we've got this in our portfolio. It's been a pretty difficult 12 months for Aussie Broadband. As you can see, the 12-month return is down 44 odd percent. I'm just going to set the scene before you dig into this particular stock. So the small ords on the ASX is down 18.65%. Calendar year to date. That compares to the all ords, which are pretty much flat, and they're up slightly in terms of inclusive of dividends. You've got companies like City Chic, which was a key pick for a lot of small cap fund managers out there that is down 86% year to date, versus something like a New Hope Coal, which is up nearly 200% year to date. That's in the small company space. In the large company space, you've got things like Novonix down nearly 80%. You've got Megaport down 65%, whereas you've got Whitehaven Coal up 300 odd percent. So there's been a lot of variance in performance across the spectrum of companies on the ASX, none more so in the small company space, which is an area that you guys operate in. What's your thesis now on Aussie Broadband? Is it something we should just walk away from? Is it something we should stay the course with?
Yeah, thanks, James. So, and thanks everyone for attending today. It's a pleasure to be here. So, look, regarding Aussie Broadband, it really has been a tale of two halves. Looking at the chart, I think it sort of indicates that. So, this has been sort of one of the better small cap performers since it listed at about $1 a share, I think, which would have been roughly about 18 months to 2 years ago now. So, just sort of stepping back a bit, like Aussie Broadband's a company that's been taking material market share in the NBN market, predominantly in the residential plus small business space, and now it's expanding greater into the business market. So, what we've seen is we saw them really outperforming through to March, April, and then we did just see a real shift in dynamics in terms of the competition in the market that was starting to come through. So, there's a number of really sharp promotional activities from the likes of Superloop and some other large companies. One in particular that was backed by CBA in Tangerine and More Telecom. And effectively what that's meant is that they've just gone through 6 months of tougher period in terms of the net connections growth of the business, James, and that's really just seen some sort of slowing in the growth, which, the small cap market hasn't been sort of that sort of across, I think, as they've shifted towards an earnings trajectory, as well as we've seen some inflation coming through across the business. So they've got an onshore call center. So, originally we were expecting these guys probably in FY23 to make sort of around $100 million of EBITDA. And they've come out this year and guided to sort of like the high 80s numbers. So we've seen some sort of consensus downgrades that are rolling through. So just to set that backdrop, look, our view is that the stock is definitely not broken. I think our view is that the actual valuation at the current time is incredibly supportive of some good returns. At the moment, you're looking at sort of like an EV to EBITDA on this stock of probably about 7 times. That compares where it's typically traded at sort of north of 12 to 15 in the past. And we've seen some real interesting dynamics coming from the NBN. So you would have seen, many of the listeners on the call would have seen the ACCC and the NBN are changing the rules to benefit high-speed tiers coming in from the 1st of July 2023. So that would be a real benefit to this stock. So, just looking forwards, I would expect that the February result would be a catalyst for the business. And we are very much in the camp that we think this stock is cheap. We think this stock is going to have a bit of a renaissance in terms of the growth, and their recent trading update sort of supports that.
So just on the earnings side, so a lot of people will see this and they'll screen their PE on current multiples, and you can see it there in the middle of the screen. It's on about 100 times. If you look out to the year ahead, so Jono made mention of EBITDA guidance sort of in the 80s. The consensus number is 83 with a net profit of 32 million. That's based on a market cap of 630 odd million at the moment. So that's on about 20 odd times forward earnings 1 year out. But if we go on the Market Matters website, you can look at forecasts. So if we go to get rid of revenue and we look at net income going out to FY24, consensus numbers are expecting 50 million of profit in FY24. So that's what Jono was talking about in terms of valuation. So you take a 50 million profit. I'm not sure what your numbers are in terms of that profit line out there, but you look at the current cap, and you're looking at a business that is on sort of 13 times, and it's growing, Jono, at a really strong clip. So to me, this is a company that's growing well, and is now on a valuation that's really undemanding for what they're going to achieve going forward. Obviously, the market's saying there's some risks around that growth in earnings, Jono. I don't know what you want to make of that, but the market's obviously still a little bit skeptical that they're going to meet those numbers.
I think that's definitely part of it. The reality is that, we talk about on the institutional side of things what's called consensus downgrades, and so for the listeners on the call, just to explain what that means, James is talking towards what's effectively the average of a number of analysts, sell-side analysts or brokers in the market, estimates for the stock. So when you see those numbers that he's talking towards, effectively that's, the 3 or 4 other analysts on the stock plus myself and what we expect them to make. So, share prices in the short term do follow where those estimates get revised, either up or down. When they're being revised upwards, stocks like to track upwards. That's been a dynamic that you probably spoke through with Peter O'Connor on the coal side. But when they do track down, stocks generally do follow it and sort of derate alongside that. So in the last 6 months, we've definitely seen that occurring because it has been a bit tougher on the competition side and on the margin side as a result of inflation. We think we're through that. We think they've taken all their medicine in the guidance that they provide, and there's actually upside to those estimates that you can see on the Market Matters website. So, the thing I would highlight to a number of investors on the call is that, Aussie Broadband's a business that's gone from 0% market share up to close to 7% market share within about 5 years. And at the moment, it's growing organically. Its subs at around 20% per annum. And that's in a tougher competitive market. So alongside operating leverage, you should be expecting to see sort of a CAGR and EPS of probably 30% per annum over the next 3 years. As James alluded to, the market's got this business closer to 10 times PE than the 20 times it's been trading at this year. And as that growth comes through, we really would expect the business to re-rate potentially materially as it comes through.
So just give me what your price target and your rating is, Jono?
I don't recall off the top of my head my exact price target, but I would expect that this stock, in sort of a more favorable environment as the earnings come through, could get to sort of north of $5 a share. And that's a long way off, but that would effectively put this stock on an EV to EBITDA of 10 times into next year. For a growing telco that's growing 20-30% per annum, I do not think, our view would be that's not demanding.
I mean, that's the key, right? It's got to show growth, and this February result is likely to. We're hopeful that it'll show that growth. I was on the call after their recent earnings downgrade, etc. It seems to me like they're guiding conservatively. I don't know how you feel about that, or whether you want to comment on that, but that's the feeling I came away from those the calls we had with management, and obviously that if that's the case, it'll bode well going into next year. We might leave it at that, Jono, on Aussie Broadband, but suffice to say we like it. We own it in our Market Matters emerging companies portfolio. As I said, we're down on it. We've got a big enough position at the moment, so we're not going to add to it, but we'd certainly be buyers of that stock if we weren't already long that position, currently around 260, as you can see. Let's move on to payments, because it's been a pretty, a hugely volatile space to be in. Obviously, we've had the carnage coming through buy now, pay later, but there's also been other areas of the payment space that have been really challenging. EML payments springs to mind. I think that stock's down about 60% year to date. Tyro has been a stock in the payment space that's had a really challenging 18 months or so. It's in the crosshairs of takeover at the moment, so it's come off its lows. Guys, what are you seeing in the payment space? Is there any stocks out there that we should be keeping an eye on?
Yeah, I mean, we'll talk specifically about one stock in a moment, which I think you've sort of, identified and been a strong performer. But look, more broadly, just speaking around just sort of the payment space in general, it both domestically and also internationally, it has been a very tough space to be. So, I'll talk briefly about Zip in a moment, but the reality is, I think Square's down something like 70% in the last 12 months. PayPal's derated by about half internationally. The credit card companies are sort of holding up. They've got very strong and dominant market positions and, are quite profitable. So it's been a bit of a different dynamic. But the payment space has been under pressure for two things predominantly. The first is that, we have started to see some compression and some competition starting to pop up in the payment space. So in buy now, pay later, that's the likes of an Affirm, a Klarna, a Square, an Afterpay, a Zip, all these types of businesses. And the second dynamic at play is just more of a macro focus. So as James alluded to at the start, the small ords has materially sort of underperformed on the industrial and technology side of things versus profitable companies. And we have seen this real sort of disparity and change in valuations, particularly of profitless companies. So there are a number of companies in the payment space that are growing sort of at very healthy rates, but they're not quite, profitable, or they're not quite profitable to a level that we can talk about your traditional valuation metrics like a price to earnings and EBITDA and the likes. And so, those companies have effectively, I think, seen probably a compression of something like 70% in the last 12 months, as we've seen bond yields like increase at the fastest rate in the last 30 years. I think, this session's not around talking about the macro too much today, but, that's sort of starting to play off. We're seeing inflation expectations starting to taper at the moment. And that's really affected the likes of, say, a Zipco. So Zipco is a great example. So shifting gear to that at the moment, this is a stock that I've covered, I think, for 6 or 7 years, both at my previous firm and also at Shaw and Partners. I think it IPO'd at 20 cents a share. I think, prior to the pandemic, it might have been $1.50, $2, something like that. And it's now derated to sort of something like 70 or 80 cents. So, Zip's in a position where, the market had changed materially on both what the market wanted to see and also the competitive environment. So, from, roughly around January, February, it started to become evident in markets that markets were starting to close for profitless companies. And Zip, was expending a lot of capital moving into rest of world, the US, these types of businesses, new product lines and the like. And effectively, they've had to transition over the last 6 to 9 months away from growing at all costs to trying to grow profitably. So they're 6 to 9 months into that journey now. They're flagging that they're going to be cash flow break even in the beginning of FY24. Their recent couple of quarterlies has shown some momentum on the costs and the credit side. So we're hopeful that they're able to do that and potentially even do that a little bit ahead of schedule in the second half of FY23. But the real catalyst for any of these companies that are burning capital will be on the profit side of things. So.
Yeah, and I'll just flag. I mean, one of the concerns that we've seen across the buy now pay later space is about the model working. So as interest rates have ripped up and bad and doubtful debts bad debts have started to move higher, does does that model work? And I don't know what your thoughts about the broader model are, Jono, but obviously there's still some concerns out there around what the future of it is.
Yeah, look, I think that's correct. I think, what needs to be noted is that, there's two different concerns. There's one on the bad and doubtful debts. So, I think what needs to be kept in mind with these businesses is that, Zip earns an effective yield of probably about 20% per annum, and they experience bad debts in the range of about 3% per annum. So, even if interest rates are higher, they're still earning an effective net interest margin of sort of north of 10%, which would compare to, say, a major bank that's sort of around 1.8, 1.9 at the moment. So, I think it's overstated that effect. Where the effect comes through from bad and doubtful debts is the majority of these alternative financiers, whether it's a Zipco, a Resimac, a PayPal, a Square, all these types of things, they're not funding their business via equity. They're funding their business by what's called securitized funding, which is they're selling debt to investors. And that's been, I think, that's a market where it can close or it can become a liquid, like what we saw with the UK gilts crisis in the last 2 months. And so that's the point to watch there. If funding markets do seize up, which they haven't, then you've got, the potential that the business model doesn't quite stack up. That compares with, say, major banks. In Australia, I think 60 or 70% of Commonwealth Bank's funding comes from deposits. So, they're not relying on wholesale funding. So there's been a real shift away from alt-fis being able to capture funding to, traditional financiers that have got a real competitive advantage in a higher rate environment.
Okay, so high risk, big bang for buck if they can get this right and turn it into a profitable business by the start of 24. What else have you got in the payment space, guys?
Yeah, maybe one from me, James. So one that we really like and one that's been flying under the radar for some time is SmartPay. So the ticker on that's SMP. So that stock's up sort of 50% plus over the last 2 months. So it's been a very strong performer. Maybe just a quick overview sort of in terms of what they do. They're an FPOS terminal provider to small and medium enterprises. So think anywhere from your local cafe, hairdresser, etc. So look, they've got a proposition in market where essentially the merchant doesn't pay for a terminal. So that's sort of passed on to the consumer in terms of in the form of a surcharge. So you might have seen some surcharging if you're at your local cafe or something like that. So that's sort of where SmartPay earns their margin. So
isn't that the same as Tyro?
It is similar to a Tyro. So they do have a similar model, but I think they also have a strong proportion of their fleet that is on sort of flat rate as well. But SmartPay's got sort of 80% plus of their fleet on what they call their Smart Charge product.
Okay, yep.
So yeah, they've received sort of significant uptake in the Australian market on that proposition, sort of given some of these cafes and things can save tens of thousands of dollars using a SmartPay terminal versus your traditional banking terminal, which will charge a flat rate to the business. So, SmartPay's got over 12,000 terminals in Australia. They're growing 80% organically at the revenue line, and they're growing EBITDA at over 100%. So importantly, they're profitable, they're growing rapidly. And if we look at where they're priced in terms of the market or versus a Tyro, so you've got SmartPay that's on 11 times EBITDA in FY24. And James, I think you mentioned earlier that Tyro is currently subject to some sort of takeover interest. So that's at 25 times EBITDA. So, very much our preference in the space is for a SmartPay. On top of that, they're investing in things like marketing. So you might see them on TV, radio, social media, and things like that. But they're managing to hold their margins steady at 20% plus, despite continuing to invest in that marketing line and continue to drive the top line higher.
Okay, so one of the concerns that I know Tyro had when it was plumbing recent lows before takeover interest was just around the aging technology that they had across there and the investment they needed to make in technology moving forward. How does that, you say SmartPay is obviously spending money on advertising and growing. How does their top tech compare and sort of the cost of that tech to maintain going forward?
Yeah, so SmartPay are currently doing a transition onto Android-based terminals. Typically they've had really strong performance across the terminal network. They haven't had any issues. I think Tyro had a significant terminal issue with bricking in the past, so SmartPay had nothing like that. They use PAX as their supplier, which is, I think it's the second largest terminal supplier globally. And SmartPay are continuing to invest in their network, in technology and compliance and things like that. So we're pretty confident in their ability to sort of keep up on the tech front. If we look at the founders and the management, they've been in the payment space for decades. They're actually a New Zealand business by heritage originally as well. So Marty Pomeroy, the sort of MD of the business there, he's got significant experience across the space. So we sort of back them to continue to invest and drive the business moving forward.
What sort of market cap are we talking here, James?
So it's currently about 250. So as I mentioned, it was significantly lower sort of a few months ago. We've been banging the table pretty hard on it, and it's had a pretty good run, but it's currently about 250 mil in terms of the market cap.
Yep. Okay, and strong earnings growth, and as the important thing I think there to highlight James' point is profitability, and not needing to raise capital all the time to underpin future growth. So payments. So there's one there. Obviously, the buy now pay later space has been a difficult one, but there's plenty of upside there if they can show profitability. And then SmartPay, which is at the smaller end of the spectrum, New Zealand based company. Don't be put off by the strong rally in share price. Obviously, risk reward when we're looking at a company like this needs to stack up, but I think it's important to think about it in terms of the size of it. So when you're thinking about a $250 million market cap business, it's small and the upside can be quite significant there. I'd be more concerned when you get these large market cap companies, obviously, that are not profitable or trying to be profitable. That's when they can re-rate pretty aggressively. So SMP, their SmartPay for James Bissonella. I'll move on now to platform businesses. So really interesting. Not sure this is in your wheelhouse, I think, James. What have you got in terms of platform businesses that, obviously scale is really important, and that drives the concept of operational leverage, but it can often cost a lot to get that, to get there, to build it before everyone comes and jumps on the platform. So what have you got in terms of platform businesses for us?
Yeah, 100%. So our preference in the platform space is Hub24. So the ticker on that one's Hub. Their market cap's sort of over $2 billion. So they're a pretty sizable business. They've got over $65 billion of FUA, or funds under administration, on their platform. Essentially what they do is they're a conduit between an advisor and a client, and they sort of digitize that investment process and sort of produce superior investment outcomes. But in terms of growth and operating leverage, James, this is a business where the share price has gone from under $1 in 2010 to sort of $28 today. And over that same period, they've grown that FUA, which is the key metric, from sort of $400 million to over $65 billion today. So significant growth at the top line, but additionally, they've also seen really strong operating leverage at the profitability line. So EBITDA margins for that business were sort of 25% a few years ago, and now they're producing 40% plus EBITDA margins sort of at the bottom line. So they're
growing and the economics are getting better effectively.
Yeah, 100%. So, as you grow larger, your sales team might sell a large proportion of net flows relative to the size of the business. You need less heads across finance, things like that. So your operating leverage is greater because your expenses are growing at a slower pace versus the top line as the business scales. But I think importantly, they're at 40% margins in that platform business at the EBITDA line, but we think there's potential for that to move to 50% plus over the medium to long term. We've seen other peers in the space that are maybe a couple of years ahead of Hub that have achieved that level of margin, but we think the upside on Hub is much greater, and you've seen that trajectory over the last 10 years. And whilst it's been sort of a 20 or 30 bagger over the last decade, we think it can definitely move sort of a lot higher from here.
Yeah, so they've doubled it. Like you look at the actuals from 21 to 22 on the Market Matters website. They've doubled earnings in that time frame. They're going from EPS of 48 cents to 65 in 23, and then 81 in 24. So it's dropping down to earnings. And I know the pushback on a company like this is around valuation, and I've got to say these sort of businesses always screen very expensively on your traditional metrics. But if you take that view a couple of years out, then that's sort of like they get more palatable in terms of the way you can think about them from an earnings and valuation point of view. Like that's the sort of time frame you've got to take. We own Hub24 in the Market Matters flagship growth portfolio. It's been a pretty strong performer for us. We like it. James was one of the key reasons why we bought it a while ago. We paid $22.79. You can see on the Market Matters website how we track all our current positions, we track our past positions, etc. All the stocks that we've done well of, we look at, and those that we don't do well on. You can look at past performance on the Market Matters website, and we track all of the information that you need. You can log, you can click through to the company page, and you get to our current views on a particular stock, the current opinions that we've written about that stock, and all the actions that we've taken on that position over time. So it puts in a nice decision tree, so you can have a really good view of what our view is, what it's been historically, and what we've done about it. So that's the key. So you made mention of it's been a strong performer, James. Its 1 year return is 4.6%. So when you think about the context of what technology stocks have done, that's a pretty phenomenal effort, trading at around the $27 now at the moment.
Yeah, 100%. And I think, as you mentioned, I think people are constantly saying to me, this stock's expensive, and they're looking at last year's earnings. But if you're doubling your earnings, then your PE is halving into the next year. And so what you really need to do is look 2 or 3 years out. And Hub has a really phenomenal track record over a long period of time. And we think it's inevitable that they're going to continue to capture market share and grow that earnings line. And they'll look cheap on an FY24, FY25 basis kind of thing.
I love a company that when they report earnings, they more often than not beat. And I think Hub is, I always get that opinion when they're about to report. Some companies you get nervous about, some companies you don't get as nervous about. There's always a level of nerves across the board. But Hub's one of those companies that more often than not beats. The last time they reported, I think the stock price was up 14% on the day they reported because of the strong underlying metrics that they delivered in that result. So Hub24 is a stock that will bang the table on still. We've got it there as now neutral to slightly bullish in the MM viewpoint there. It's obviously had a really strong run and outperformed the broader sector, but it's done that because it's executed. And I remember, James, one of the things that you told in the last webinar, I think we're doing a deep dive into Hub, and it's on the Market Matters website for anyone that wants to go back and listen. You said you've got to cast your eye over the noise. It can be a pretty noisy stock, and there'll be dips in the share price based on sentiment and a whole bunch of reasons. But over time, this thing's going up, and it's certainly played out. So well done, mate. Thanks for tipping us into Hub24 quite a while ago.
Absolutely, no worries.
Now let's move on to funds management businesses. And just the other, just before I move on to that, the other platform business that we do own, it's not covered by James or John, it's covered by another analyst here, but we also own Premium in our emerging companies portfolio, another platform business, smaller end of the scale, more potential upside, more risk. We use Premium on a daily basis here for managing portfolios and the like. So it's a business we're particularly familiar with. So that's another one that we hold in our emerging companies portfolio that might be worth a look. We're going to move on to Regal Partners. So it's a new one for us, new one that you've recently initiated coverage on, Jono. We've gone and bought this stock a couple of weeks ago. We're currently up around 20% on the position, which is shown on the Market Matters website. What's your thesis around Regal Partners here, Jono?
Yeah, thanks, James. And on the chart, just to make everyone aware of just what's going on in this business. So Regal Partners, I think, has really only been effectively the case since I think July or August this year. So originally Regal Partners was VGI Partners, which has publicly gone through some tough performance through that period. So really what happened is that Regal, which was an unlisted funds management business, one of the largest alternative and hedge fund managers in Australia, took the business of VGI over via a reverse merger in July or August. So at that point, the share price has gone from, I think, $2.60 at that point, which was the effective price post the dividend, up to, I think, north of $3. So just to make everyone aware, just on the share price, its chart, I think, need to give it some benefit there.
Yeah, great point. So the investment thesis in simple terms for me, Jono, is around Phil King and Regal coming into a unloved vehicle that's had pretty significant underperformance. It's trading a pretty significant underperformance, or their funds have had pretty significant underperformance, and that's been reflected in the value of the funds management business. If you turn performance around, your funds turn around, you get better fund flows, and that flows into an improvement in the investment company that sits over the top of it.
Yeah, so look, that's exactly our thesis. So this is a recent initiation. The reason why we've initiated on this stock and put, I think at the time, 100% TSR, which is the highest that I've done.
Exactly right. So you initiated when it was what, 260 or 270 or something like that?
Yeah, 260, I think, and it's gone sort of to, around that $3.
348, yeah.
Yeah. So look, effectively, Regal Funds Management is the leading provider of alternative investment management and hedge fund performance on the equity side in Australia. Phil King, who's the CIO, is somebody that's presented a number of times at Shores and is a client of the firm. Effectively, his flagship fund since 2004 has returned something like 22 or 24% per annum. So if you compound that over time, he's turned $1 into, he's effectively turned, something like a 7,000% cumulative return since 2004. And that's been undertaken through a number of market cycles. So, that's all been done in the unlisted end of the market. It hasn't been widely available to retail investors. There is a listed LIC, which is RF1, that has some access to retail investors that you can buy on the ASX. But RPL effectively is the funds management business for all those strategies. So I think at a high level, what the key points on RPL is, as you said, I think, we should see accelerating levels of funds under management. We should see accelerating levels of performance fees, which are the returns that they get. These guys have a long track record of delivering significant outperformance. The last 6 months, they've been very good as well. And I think more relevantly as well is that, you're effectively getting an earnings multiple on a business that can have huge leverage to those performance fees. So I think I've been quoted as saying this is, this business has the potential to be the next Magellan. Look, the difference.
Ooh.
Yeah, the difference.
That's a big call, Jono.
Yeah, and hopefully not the Magellan of the last 12 months, the Magellan of the start. But look, effectively, funds management businesses are great businesses to get on at the start when fund managers and the founders are heavily incentivized and looking to grow the vehicle and grow the performance. Where fund management businesses really turn over is when you lose that from the CIO and you lose the smarts and the people side of the business. So, Magellan was a business that reached up to, I think, $110 billion in FUM via an institutional model internationally. So they took really high balances from institutional mandates and they charged the customers 30 to 50 basis points. very little in the way of performance fees, but then, rode the tech boom. The founder left and had difficulties, well-publicized difficulties in the last 6 to 12 months, and that's obviously collapsed. Compare that with Regal. This has only recently been listed in the last 6 months. This business is now attracting about $1 billion in FUM a year at the moment. It's got $5.5 billion in FUM there, so there's a lot of leverage. And the difference between Regal to these other fund managers is this company takes anywhere from 15 to 20% performance fees on an absolute value. So, whereas your small cap managers take sort of 15 to 20% over a benchmark, so say the Small Ords or the ASX 200, Regal takes 15 to 20% over absolute. So if a Regal portfolio does 20 or 30% for the year, they will take 15 to 20% of that number. So there's a huge amount of leverage in that business, and you're getting it right now. Regal's got one of the best balance sheets in the sector. So they've got, I think, 250 million in cash and investments. It's about 30% of the market cap. And they're on, I think, a cash PE of about 10 times into next year. So when you get leverage in performance fees like what they do, and you're getting accelerating rates of FUM, this is a company that I really think people should be watching, because, effectively you're buying an earnings multiple on a guy that's been able to do 20% plus per annum over the last, circa sort of 20 years.
Yeah, I mean that's the risk. So we're both the investment thesis obviously revolves around performance, and we've seen what performance did to Magellan at the start, and then we saw what performance outcomes did to Magellan at the end. So obviously it's not without risk, and you've got to be backing Phil King and his team to continue to deliver performance, and they certainly charge on performance, as Jono has made mention of. But if they execute well, then there's plenty of upside in this. We're capped at 900 odd million, Jono, at the moment.
Look, I think that's exactly right. I mean, there is a broader structural thesis as well. Magellan originally enjoyed this shift towards international and US equities, and had a weighting to tech. Platinum had a focus. Platinum's another ASX listed fund manager. They had a real value bend. Regal is an alternative funds management business. So in the US, alternatives, which are things like hedge funds, private credit, venture capital, they're circa 25% of all capital in the US, and in Australia, it's less than 10%. So over time, it's been sort of empirically proven that if you have a greater weighting to some of these alternative investments, a balanced portfolio should outperform. So they should see a structural reason why they continue to grow, as well as you correctly identified, the performance is key in the near term.
Yep, totally agree. We won't delve into what's playing out with Perpetual, Pendle and their Regal and Co's tilt at Perpetual, because there's a lot to get into that. And it looks like Pendle and Perpetual are going to join forces anyway. In terms of one more topic very quickly, just on, I put it out there on cybersecurity. It's more around cyber safety. We've got one stock there that you wanted to highlight in that space. Go for it, fellas.
Yeah, thanks, James. That's Family Zone. So the ticker on that one's FZO. So, that company's stated aim is to protect every child's digital journey. So they sort of operate in that cyber safety space, particularly in schools. So, these products have seen multiple instances where they've actually intervened and saved children's lives. So it has real world sort of applications and is making a real difference. So, they've got multiple products in market. They've got a 40% market share in the UK. And sort of a 16% market share in the US, and over 12 million students that are actually on their platform. So, it's a significantly sized business and has significant scale. So in terms of products, I won't spend long on this. They've got a call filtering product. They've got a monitoring product, which is a bit more proactive. That does things like screen capturing and key logging and things like that. They've got a classroom product that teachers can use in class to control students' laptops and make sure they're on track in terms of a class. And they've recently acquired Custodio, so that's a parental control tool which parents can install an application on their child's device and sort of restrict activities and set times for gaming or schoolwork and things like that in the home.
It's a challenge, mate. We all have that challenge every day of the week.
100%. Well, yeah, I think Jono's probably a little bit away. I think he recently had a boy, but I'm not quite at that journey yet. But,
I'm showing my age.
No, 100%. But yeah, I mean, Family Zone saw a really meteoric rise throughout COVID, sort of as classrooms moved towards digital operation. We've seen various US governments and the Biden administration recently pump $125 billion into the sector. And schools over in the US, they're legally mandated to have this product under the Children's Internet Protection Act. So it's got really strong, defensible, sticky sort of revenues. and they've got $80 million in terms of that ARR, or annual recurring revenue metric, which is the key metric in the sector.
So that's the large proportion of revenues on a reoccurring basis, and you can see there on the chart between 22 and 23 how much the top line is increasing by out to 24. I'm noticing I'm not sure what your numbers are on this in terms of earnings, profitability, and when they're going to break even in terms of your expectations, James.
Yeah, so I mean, obviously it's a key catalyst for these tech stocks, which typically trade on a revenue multiple in terms of when they can reach profitability. So I think importantly for Family Zone, sort of last quarter, they did have a cash flow positive quarter. I think importantly, that was a seasonally strong collections period in terms of the business, but in terms of when we're seeing them sustainably reaching cash flow positive, it's probably towards the end of FY23. And we think that's a material catalyst that could see the share price higher. But I think sort of on top of that, we think it's very much a strategic asset. We've seen a lot of M&A across the tech sector. So we've seen things like Nitro, Nearmap, Big Tin Can, MSL Solutions on the smaller end of the spectrum be subject to takeover bids by the likes of private equity. And we very much think that Family Zone fits that bill because it has a global presence, it is approaching cash flow break even, and it is relatively cheap in terms of where it's trading relative to that revenue metric.
And there's only 2 analysts that cover it. You're one of them. You've got a buy on it, and there's another one out there that's got a buy with consensus price target double where it's trading at now. So FZO is the final stock that in the cyber safety area that the boys wanted to highlight. In terms of just a couple of queries there, someone was asking around what TSR is. That's a total shareholder return expectation. So the difference between where the guys the target price is, so where an analyst target price is, and the current share price, that difference gives you a total shareholder return. If the company pays a dividend or the stock pays a dividend, that also accounts for the dividend there as well. So how much upside effectively is in the stock was one of the questions in terms of that. We're going to leave it there. I'll thank you guys very much for your coverage today. Just to wrap up, we had Aussie Broadband as the first stock that we're looking at. We're down on the position, but we like it. We think their February update is going to be one to drive the share price higher. It's all about showing growth coming back into that business. In terms of the second thing we talked about was payments. So we highlighted how tough it's been in buy now, pay later, that there is still some upside potential in that area if they get it right and if they can turn that model profitable. But SmartPay was an interesting terminal business, similar to Tyro, but better on a smaller market cap and about half the price that we like. So SMP is SmartPay. In the platform space, we like Hub, and we're long Hub in our flagship growth portfolio. That's been a great one for us, and we intend to hold that. We also, the guys don't cover it, but we also own Praemium in our emerging companies portfolio for Market Matters. The fourth topic we covered was the funds management space, and why we like Regal Partners. There's plenty of upside, I think, in Regal Partners. We've bought it recently. We think there's a really great story, both in terms of what they're delivering from a performance point of view, but also the structural flows going into alternative assets over the coming years. So RPL, go and have a look at that one. And then the fifth one was just around cyber safety, which is Family Zone, FZO, trading at 30 cents, about a 200 million market cap from 250 million market cap from memory. There you go, 282 million market cap from memory. So guys, thank you very much for insights today. Much appreciated.
Awesome. Thanks for having us, James.
And just before I go, there are next week's webinar for Market Matters. We're going to take a completely different path and look at the hybrid space. So income securities listed on the ASX. It's actually been an interesting time over the last couple of weeks. There's been a lot of money going into hybrids. I was looking at our income portfolio this morning, which is the Market Matters active income portfolio, where we have a proportion of that held in hybrid securities, and some of these have done particularly well in the last week or so. Things like the CBA PG was actually up 2.6% in the course of the week. So clearly that's a big move in terms of hybrid. So we're going to get Cam Duncan, who runs a hybrid portfolio with over $1 billion in it. They're also very active in the hybrid space on a daily basis to give us the overview, the good oil on the hybrid market. So tune in next week for the focus on the hybrid space for the Market Matters webinar. Then thanks for joining us. Thanks, Jono. Thanks, James. Bye for now, guys.